And we're live. Phil Tarrant, Tom Panos, Real Estate Exposed. Welcome to Thursday. 4 more weeks left before the Christmas shutdown. Tom, you've been very vocal about this. I've heard you say it 1,000 times. Christmas isn't here yet. You've still got plenty of work to do. What are you seeing in the market? Real estate agents starting to put their feet up, mate?
No, not as much as I thought they would. They're either following my advice or they're taking advantage of what you called earlier on this year, the spring that never happened. But there is a bit of a late spring, early summer market. So my 17th of December, Phil, is totally booked out. So we're talking in a week before Christmas. You can't book an auction with me now, right? And I'm always an indicator of the rest. Like whatever I'm doing, the other auctioneers are doing. It's a clear trend line. So there is stock there. People are panicking. They're trying to get rid of stock because they'll feel safer doing it now than coming back into the new year. And I can see agents working. I don't know, maybe in 2-3 weeks' time, Phil, we're going to say, we're seeing agents having, lunches and dinners out in town. But at the moment, I've got to say to you, they are working. And Phil, the most common thing I'm asked is, if I've got a property at the moment that's on the market, should I hold off and see what happens next year and get more money, or should I sell it? And then buyers are asking, how late can you leave it to buy a home and time the bottom? So, Phil, today I'm going to bring up a graph, and I want me and you to talk about this graph because it's I posted it up the other day. In fact, I'll bring it up here right now. There it is there. And I don't expect our listeners or viewers that are listening to this on the podcast, or even those watching it online, to be able to read deep into it. But Phil, what it's basically saying, in the last 35 years, there is around 9 corrections that the market has seen. And there are some learning in those corrections. The most obvious learning is that a correction on average goes for 20 months. So yep, go on.
No, so I was just for our audio listeners and for those of you listening to this on the RAB podcast or Smart Property Investment Show or some of the other podcasts, Tom's surprised me with a graph here which says last 9 corrections as of February 2019. So as Tom's talking, I'm just having a quick review of it, trying to understand the nature of this and how far the corrections are and the lag of them. What you'll read of this, and for those audio listeners as well, the big headline Tom's put at the bottom of this live stream is, has the market bottomed? And I guess to Tom's point around that question is being asked by buyers and sellers running up to Christmas. Should I sell before Christmas or wait till next year? Or if I'm a buyer, should I buy now or wait till next year? And that all comes around the psychology of, is the market yet at the bottom? Hence the reason why we have this headline, has the market bottomed? Over to you, Tom. What's your read, mate, on that?
Okay. So I've been able to look at that graph for a lot longer, and I went over it with John McGrath about 3 weeks ago, and we came up with the current view. The good news is markets always go back up. That's the first thing. In the 35 years of data, there's no need to despair thinking this is going to be long and it's going to be hard and it's not going to end. No. We're including what happened in 83. We're including what happened in 1989. We're including the GFC and all the others. And it's very clear that on average, it's a 20-month retraction for 20 months. And then, Phil, what happens, whether it's 18 months or 2 years, then what happens is it slowly starts going up. So if you look at the current data that we've got, Sydney and Melbourne began at the start of this year, maybe February, March. I think the first rate rise was in the first quarter of this calendar year, where they had a 0.5% increase. So if you turn around and say, where has the retraction started first? Sydney and Melbourne, and then it started spreading out into further areas. And the only place that has been untouched is Perth, right? Now, SEBA is a wonderful agent out in Brisbane that does a lot of commercial, and you can see what she's saying here, Phil. My buyers are waiting till mid next year. They are watching and waiting. And they're commercial people. So Phil, let's go through the various people. Let's go through the various people involved in a decision here. The first one is, if you're thinking of buying, it's basically saying you've got between January and August next year to buy a property, or from today onwards. If you're a vendor and you're sitting there saying to your real estate agent, the market's not great at the moment, let's wait till next year. Well, that's basically saying there's a good chance it's going to get worse before it gets better, because in most parts, we're not even halfway in that decline. And then what about if you're someone that is thinking of coming onto the market? Well, it's sort of saying, if you're going to sell and you're not going to buy, maybe just wait. If you have no need to sell, maybe just wait. But if you're seller and buyer, it's irrelevant, because you're going to be transacting in the same market. But I think for me, Phil, I think it gives me a lot of comfort knowing that we've got a proven formula that's gone for 3 to 4 decades, and that is that it's not normally a 5 or 10 year retraction, Phil. It's around 20 months on average. And we're about half.
Yeah, just to simplify this. So from the start of the retraction to the bottom of the market, as in it doesn't retract any further, is 20 months on average. And then is the speed to get back to where prices were 20 months the other way, or is it slower down, faster up, or is it faster down and slower up? Because that's the important point. If you can, and what the graph that you've shown everyone, it allows us in hindsight to say it takes 20 months to get to the bottom of a retracted market. We're talking generally here that different markets move at different speeds and all that sort of stuff. Is it 20 months to get back up, Tom? Because that will be critical. Now, what's going to accelerate the market faster upwards than what it was downwards? And there's a whole bunch of factors that will shape that: monetary policy, supply chain constraints, all this sort of stuff. What's your view?
So
same speed down as up?
Answer the question about, does it mean it goes up in 20 months as well? That graph doesn't actually cover that. So it's unclear for me to actually say this is what the graph says, you know. And what was the second part?
The market started going south in May, Tom. The first interest rate rise, 35 basis points by memory, 3rd of May, which is just before the federal election. Remember, everyone talking about, are they going to do it before the election or not? So that's May, June, July, August, September, October, November. We're only 6 months into a 20-month cycle, 7 months into a 20-month cycle.
Yeah, having said that, Phil, having said that, the Sydney and Melbourne market actually started to go down even before the rate rise. So
yeah, and you said in March. Yeah.
If you were to ask real estate agents, many agents are saying the peak of the market was November 2021. That's when the peak of the market was. And then what happened? It surprised everyone because it sort of did go down a little bit. And then, Phil, we came back in January because there was no stock. It always happens. There was surprisingly some good results. And then that fizzled off. And then it started waning, and then bang, when that 0.5% came in, that's when Sydney and Melbourne, we saw the tap get turned off. But that didn't happen in other parts of Australia. I mean, Adelaide's only now beginning to see longer days on market. The Harris team, who sell a lot of real estate there, are telling me they can't even clearly see declines in their market yet. Brisbane's only started to happen in the last few months. Hobart did happen a little bit earlier. So various cities have started, and normally what happens is the cities that went down first are the ones that recover first. That's what normally happens.
Yeah, but we don't know what speed the recovery is going to be, and crystal ball gazing. We said we're getting economists in to maybe give some sense for how quickly we'll come out of the bottom of the market. So to summarise, has the market bottomed? Well, every state, every capital city has got to perform differently. Some of them are only at the start of their softening cycle. Brisbane. So on that basis, then you're saying it's going to take Brisbane 20 months to get to the bottom of its cycle. We just don't know where that bottom will be, or it probably won't last that long.
Either or all of those things. I mean, they're probably just 3 months, 4 months behind. It's always the case, Phil, because when the market goes up in Sydney, the Queensland agents are going, oh, wow, we wish you had your market, right? And then when the market goes down in Sydney, they'll turn around and say, no, we haven't noticed anything yet. You know, it is a Sydney. Look, data across real estate in Australia, because of the amount of transactions, are so heavily skewed to Sydney and Melbourne markets, right? They sort of move things up or down because of sheer volume. But, you know, Phil, I think it's really important that we talk about this. And the reason why is that there is a few doomsdayers out there. I mean, whenever I post stuff on social media that's got to do with the markets, there's a lot of people that go in and say, oh, but you don't realize this is the beginning. Inflation's through the roof. We've never had a COVID scenario ever before. Interest rates are going to keep going up. So there's always this view that this time it's different. This time it's going to be really, really dark. But Phil,
I reckon you go back and look at all the media through these last 9 corrections. Everyone would be saying the same things.
They do. And I don't know what it is, but I can tell you one thing. If I want to get my metrics up on my social media, and I know the importance of share, like, and comments, all you got to do is talk about the real estate market, and the comments start pouring in, and they're very heavily weighted to people saying this is just the beginning. We're about to, hit the cliff.
In some markets, Tom, it is just the beginning. To your point, if it's a 20-month, if traditionally it's a 20-month cycle to the bottom of the market, it's just the beginning for some of these markets. Brisbane, for example,
100%.
Okay, great. Okay, what do you do about it is the question. If you're a real estate agent, what do you do about it? If you're a mortgage broker, what do you do about it? If you're a vendor, what do you do about it? If you're a buyer, what do you do about it? If you're an investor, what do you do about it? This is when you go from being an armchair warrior looking at numbers and economic forecasts and property dynamics and all this sort of stuff to taking action. Now, some people just won't take action at all, Tom. Most people won't take action, but the smart operators will.
Yeah. And I get why people don't take action, Phil, because if you think about it, markets operate with fear and greed, right? Greed, when you see the market going up, you want a slice of the action. So you're jumping up as it's going up. Fear, you're panicking. You're panicking that things aren't going to get good for a long time. So even though there's great buying opportunities out there, you choose not to take them. You just think it's going to get worse. I've got to protect myself, right? So you've got to somehow have this brain that's going to work opposite to what's actually happening. And some people that have been experienced, some people that have been around a lot, some people that have seen this path go actually jump in and do it. So I totally get it. I'm in the same boat. I think I get, influenced by the fear and greed, and that's someone that's worked in the industry for 35 years. So
really interesting point, Tom. So the question I got around that is, because you work in this industry, you live and breathe real estate. You probably dream real estate, no doubt, even when you're not working inside of real estate, across many different levels. You have your long tenured history with the newspapers and running advertising teams. So you see you view it through one lens of listings. You see it through the work you do with the real estate gym, helping Australia's best and brightest be better agents. You see it through the lens of your speaking across many different areas and also countries. You're in New Zealand, I know. You see it through your auctioneering, on the ground, a weekly injection of ground truth, what's happening there. You see it through your commentary and interpretation through the press, what we do here on this podcast. So can you change your perception of real estate in a day depending on who you talk to? How do you have a good relationship with that?
I think I'm no different to what I heard on a business channel about 6 months ago, and that is most CEOs can't help it but make decisions on their businesses by flipping through the Fin Review. It affects their thinking, right? Whether we accept it or not. I mean, we are people that make emotional decisions and we then justify them logically. So yes, I changed my mind. I must say, Phil, the one thing that probably is different in someone in my situation is that I'll read stuff and I'll hear stuff, and then all of a sudden you're at an auction on a Saturday and you see that it's deserted. There's no one there. So you sort of couple the two up and come up with an opinion based on commentary and what's happening at the coalface, right? One thing I can't help but feel, everything that's happening in the real estate market, there's this subset of market, there's money around, and these rich people, these wealthy people don't know where to park it. We can't get away with that. I mean, I was talking to a commercial agent, and he told me about a KFC that sold for 2.83%. And I said to him, 2.83? He goes, yeah, that sold for 6 months ago, net 2.83. I go, oh, they must be flipping out now because rates are now at 6%. He said, no, probably not. Probably not. Well, and I said, why is that? He goes, oh, he was a cash buyer. He goes, most of these people, they've got cash. They want to park it somewhere. They might be scared to putting it into the share market, right? They're not going to be putting it into crypto by the looks of things. So they've got to park it somewhere, Phil. So where do you park it, right? Real estate's still somewhere you can park. And then you've got the expensive prestige property. And that's another reason why people are investing in that, because that's another way to park your money and get the family home's the last remaining tax haven in Australia. Let's be very clear about that. You buy a home for 15 million, you sell it for 8 years later for 25 million. That 10 million is tax free. That affects your return of investment significantly. We can't, forget about that. So I'm just looking at some of these comments coming through. If we already come down 15 and 20% in certain areas, how much more does it get? That's a good point with Cameron. These markets, Phil, a lot of these markets have gone down 15, 20%, This guy here, Mark, what's he saying? Do your homework on 5 to 6% rates. If the numbers work, buy. Do not buy for negative gearing. Agents will always put a spin on it. Yeah, that's sort of true. What's your recommendation to this question, Phil?
On new builds, I guess there's probably two ways to look at new builds. It's either you're doing the building yourself, the development, or you're buying a off-the-plan type house and land package or a new off-the-plan apartment. Two very, very different things. Now, to talk about the former, that is the opportunity through development, smart operators I know are having a good look at it at the moment, and there's a number of different reasons why. I sort of dial in with a number of different builders and just getting a sense check of that particular sector. Now, what I'm hearing is that builders are starting to return phone calls to people who are interested in building stuff, and that's a real clear indicator of what's happening inside of the building sector. Now, it's been a lot of headline bankruptcies and insolvencies in building, and I think a lot of that's to do with sort of cash flow management and fixed price contracts. They're starting to say that materials are starting to come back, and there's less supply chain pressures. Also, a lot of the work that was stimulated by the government grants around building, which they sort of put out through the COVID period, are starting to run their course. So builders are getting active again now. Developing property, and if you're an agent who sells blocks for development, or a mortgage broker who are helping property investors or owner occupiers build, you should be right across this. In this sort of bottoming cycle, if property prices are coming off and there's more capacity within the building sector, might be time to start having a think about new builds for the purpose of buying to flip, or buying to keep, or buying to invest, or whatever it is. On the other side of that, off the plan type developments or house and land packages, committing yourself to big purchases right now in a softening market, I'd probably be worried about that. Number one, because are you going to get the valuation that you signed up today in 2 years' time? Don't know. In 2 years' time, are you going to be able to borrow the money that you need to borrow to finish the purchase if you're not a cash buyer? I've got some concerns around that right now. I won't be operating in that space. So horses for courses on that one, Tom, but there's two very key different dynamics around that. But in markets going down, I've seen a lot of people blow their dough on being tied into contracts for new build stuff. Now, there's a problem of trying to settle it at that point in time, but what else could have you done with that money over the 2 years that's been tied up in a contract to buy or secure an off the plan purchase, whether a house and land or an apartment? So that's just my summary.
Phil, I'm going to try and bring up a property up here now, and I've never done this before, but I'm going to bring up a property that I actually think is an absolute beauty for people to look at.
We're getting outside of our remit here, Tom. Thought we're just supposed to talk about property in general.
This one's for you, Phil. This one is for you. If I can bring it up here, because I want to talk to you about why people are still buying real estate. I don't think I can bring it up here, right? But I'll tell you what it is. It was picture this, a childcare centre with long leases in Brookvale, strong tenant, big parcel of land, $300,000 a year net rent, $300,000 a year net rent. It's got a price guide of $4 million. So, think about that for a moment. That's $6,000 a week rent, locked in away with a long-term childcare that's fully booked out. I mean, there's going to be a lot of buyers on properties like that, Phil.
Cash buyers or leverage buyers?
Well, look, I'll just do the very quick calculations. Even if you were borrowing $4 million, Phil, the whole lot, right? Yep. 4 million times 0.0. What do you reckon you're going to get rates at the moment?
Commercial, 7.
7, okay.
7. Yeah.
It's $280,000 a year cost for a $300,000 rent. So that pays itself off, right? Unfortunately, it doesn't look as attractive as it did 8 months ago, Phil. 8 months ago, there was a big gap.
This is the point around commercial property. Yeah, that's the key point of the commercial property. Those numbers looked really good, 8 months ago, and they've come back. Now, does that inherently change the value of commercial property? Well, that's a decision you need to make. But that's gone from being something which was putting money in your back pocket to something that you're covering holding costs. So you'd be hoping that the property goes up in value. Now, you might need to sit on that for a couple of years before anything happens, right? And if you need to sell it in the market that we're in right now, are you going to get your money back? These are all things you need to think about, Tom. But talking like commercial property investor, are you buying that? Are you looking at that one?
No. I mean, look, if I had lazy $4 million sitting in a bank account, it would be wisely spent there. You spend $4 million and you got $6,000 coming in. Tenant pays for everything. No land tax, by the way, Phil, with the childcares. But I'll tell you another thing that came out this week, which I looked into very deep, was these new reforms that Perricay has brought in about deferring the stamp duty. What's going to happen, it's very clear, and I didn't understand it, but I do now. 1.5 million is the threshold. So everyone that's got a $1.6 million home is going to want to take the price down to 1.5, right? Because it's
land
going to
value. That's land value.
Is that land value?
I believe it is. It would be the value of the land, not the value of the property.
My understanding, and I'd love to get this clarified, Phil, I'd love to get this clarified. My understanding was the purchase price.
Okay, I may be wrong. I'm not across it all, but normally, land taxes tax at the value of the land, not value of the contract price. If you're paying land tax, right? Stamp duty is something very different.
Yeah. So what it is, so this is basically what Perricay's brought in, and it's actually valid from now. It's actually started. If you buy a property at 1.5 million and below, the stamp duty that is payable, you may choose to go with this option B. Option B says you'll pay no stamp duty, but you'll pay a land tax. And that land tax is going to equate each year on a formula, which I don't know exactly what it is, but it will get paid every year. Here's the surprising thing. If you sell it after 2 years, that's the end of your commitment. That's the end of your commitment.
Really?
Yes. And the other bit I'm very certain is that I was under the impression it was the purchase price. So that's Andrew. He's a great buyer's agent. He was at the block on there.
Yeah,
but I think
yeah.
He's a Melbourne agent. I was under the impression it was the purchase price up to 1.5. So was I. And Phil, it appears it is the purchase price. But what you're saying is when that gets transferred to being a land tax, they're going to value it. They'll value it on the land. You know?
Yeah, I've got to get it right across the. Well, normally you obviously pay land. So if you pay your stamp duty up front, and land tax is only payable on properties over certain thresholds and what sort of what sort of vehicle you hold the property in. You've got it's a complicated matrix, but you pay land tax if you do pay land tax on the value of the land, not the value of the purchase price. But what you're saying with Perricay's new structure here, so if you buy a house, you go, no, I don't want to about the land tax, you still pay the stamp duty on the total amount. Is that correct?
No. Under his new plan, if you buy a home and it's under 1.5 and you're a first home buyer, you can choose to use option B. Option B, you pay no stamp duty.
Yeah.
And that you pay a land tax on a yearly basis, which is significantly lower than the stamp duty, but you pay that each year. So Phil,
sorry, but that particular. So what would be the land tax bill on $1 million property, purchase price property? So each year under option B.
Yeah. So Phil, it's not the current land tax formula. It's a new land tax formula. It's been specially designed to do that, right? So if someone can actually put in, because actually it did come up on the screen the other day, I think it's $400 plus something %. If someone can bring that up, that'd be good. But Phil, why this is important, this is actually a very big move, because if this becomes something that other states adopt and then they extend on it, we are going to start seeing real estate markets become fluid. Stamp duty is a big barrier of entry in transactions. I've got a mate of mine who's exchanged contracts today on a property in Spears Point, for $10 million, and he asked me to calculate the land tax. I went onto a calculator, $653,000. Think about that for a moment, Phil. $653,000. So essentially, one of the reasons why volumes don't happen in real estate as much is the cost of transacting, Phil. And I really hope it gets widespread. It'd be great news for the real estate industry.
Well, but it's only for first-home buyers, correct? To help with affordability and get them into property. Yeah. And housing affordability for first-home buyers is always been something which is always tinkered with in the background. Look, I take your point and I agree with it that it will put. Well, what will happen, Tom? And this is where a lot of the criticism will come. One of the factors is that if you have more buyers at a particular price point, obviously supply and demand, there's more people looking to buy. Therefore, those properties in that price point will have positive upwards pressure on it, which means that first-time buyers will end up paying more for the property as it is right now, because it's got to put that positive factor up. The counter to that is that the cost to buy that number one means you can get to the market quicker. And to your point, these downturns don't last forever. So you can buy at a point in time which might be beneficial. That's good for first-time buyers. Number two, you're in the market. You get the benefits of capital growth. That's good for first-time buyers. Number three, you got some debt. You can show you're a good borrower. That's good for first-time buyers. However, there's more first-time buyers in there, so expect to pay more. You can allay a lot of the cost to transact over the course of the holding of the property. So as long as you've got good management, you do your sums right, you don't over-borrow, you don't stretch yourself too far, and you factor in the new land tax component under this option B into your budget, I could see it being a real enabler, Tom, and that's great news for first-home buyers. For property investors, probably less so, because a lot of property investors operate in that same space where a lot of first-home buyers operate. So if prices are going up, property investors might sort of wane a little bit on operating in those markets. Maybe there's a few buyers agents tuning into this and give some sense for that. But what's Jennifer say?
There's an example on the New South Wales government website that says on a $1.2 million purchase, this equates to $2,560 tax liability each year, right? And while that's happening, Phil, I'm just going to work out very quickly stamp duty, New South Wales calculator. I'll just quickly work this out. As you can see, we're very professional here, gang, doing it on the run here. So currently, if you go on the original formula, your stamp duty would be $50,500. $50,500, Phil. Phil's just frozen there. There we go. Jennifer's brought it up as well. Yeah. So those, I'll just keep talking until Phil comes back on. So basically what you're looking at is if you turned around and used the new formula on a $1.2 million purchase, it would be $2,560 a year. And I want to let you know. So, Phil, you're back?
I'm back. I ran out of power. Amateur.
So Phil, let's talk about. Jennifer's been very kind to actually do the calculations, and I've done them, and she's spot on. This is the big difference. At the moment, if you go for option B, you pay $2,560 in land tax a year. If you chose to go with the existing model, you're paying $50,200 up front. And what's interesting is that this is going to take 20 years to get to this number, right? And what Perriquet's done is if you sell the property after 2 years, you stop paying the 2,560. He hates stamp duty. The guy hates stamp duty. We all hate stamp duty.
So to your point, Tom, that's just going to increase liquidity. So if people, it's great if you're in an upwards market. Imagine if you just trade every 2 years on new property, but you only get it once if you're a first-time buyer. So after 2 years, you buy a new joint, you get rid of your land tax liability. However, you got to pay stamp duty buying a new place. So there's going to be a level of equilibrium. Look, I'm sure the state government isn't doing itself out of some tax receipts, right? Let's be clear. The state government needs the money coming in to pay for stuff, right? So they would have had some bright boffins or actuarials that have worked this out. So at least, and I haven't looked too far. So at least they're at a neutral level in the long term. The state government's not going to do himself out of money. They've probably looked at it, how they could be able to get more people into their property faster as the key point. But they're not going to give away anything. So bit of gamification there, Tom. How many people hold on to their first home for 20 years? I reckon they've gone back through history and worked that out. They'd have all the numbers there. It sounds good, the front end. But if you do buy your first home and you have it for 2 years and you pay 2 lots of $2,500, that means your stamp duty equivalent is $5,000 versus $50,000. So it's, a tenth of it. But guess what? In 2 years' time, you might be buying in a rising market, which means you're going to need a few bucks. I'd be putting that money away in an offset straight away because you're going to need it the next time around to buy another property.
I can tell what's going to happen in the next week or two. Real estate agents are going to be going to vendors that are on the market at 1.6 and going to try and convince them to put their property at under 1.5. And You're going to have vendors who are currently got homes at 1.3 or 1,350,000, and they're going to think to themselves, let's put it up. They're getting a discount, right? They're buying cheaper. Let's put our price up. It always happens when there's a change.
The new price for first home buyers in Sydney is going to be $1.5 million, Tom. 14999.99. I know you like decimal points in your property sales.
Yeah, like Bing Lee, 14.99.99. Get it now. You're going to be saving yourself $48,000 in the first year. That's the sales pitch.
But the thing is also, I'm really keen, and you'll see this out over time. I really want to see that in auctioneering, how fast property is going to go up to 1.5, and then a handbrake gets pulled. The new reserve is being set for property in areas, mate.
Yeah, good point.
You should just start. We're going to start our bidding at 14.9999. All the first home buyers will put their hands up. You get rid of them straight away. Then you got the real buyers after it.
Yeah, and a message to every real estate agent and auctioneer out there, trust me, don't ever take advice from your vendors. I had a vendor say to me, please announce this on Saturday to all the buyers. I said to him that your property, you want 1.9. And he said to me, yeah, but they still get the benefit up to 1.5. And then it's only the next 400, which is not correct.
That's not correct.
That's not correct. The minute you go over 1.5, that property does not qualify.
So if it's $1,501,000, you got to pay your stamp duty on the normal. Yeah,
correct. Correct.
I'd be really, really interested to see how many suburbs in Sydney, Tom, where first home buyers might be operating have a sort of average sale price of 1.5. Half of Sydney. The biggest impact, because you're going to have a lot less impact pretty much anywhere. Well, it depends. Anywhere west of Parramatta, I was going to say, but if you get up into the hills, you got a lot of properties there over that sort of amount. So,
would have been Phil. Would have been half in February. It's not half anymore. I think it's less.
So to that point, also for first home buyers in this softening market, you can if you're smart and you trade well, if you buy up to $1.4 million in a place which in the last market would have been 1.6, 1.7, it means you're getting a huge discount on the stamp duty at that rate at that point in time. You only got to pay up $2,500 a year for 2 years, and if those markets return, you're going to get the arbitrage on the purchase price, and you're also going to get the savings on the stamp duty and land tax options. So that's the smart first-home buyer right now. That's where I'd be playing. I reckon buyers agents, there's something in it for there. If you can specialise for first-home buyers on identifying those suburbs, of which there's probably, I don't know, call it 50, maybe less, 30 in Sydney, who have dropped down below that threshold. That 15 to 20% is down under 1.5. That will come back in 20 months' time. You time it right, Tom, 20 months from bottom to top, bam, that's where I be.
Yeah, well said. Phil, I think if you're buying a home right now, you're already ahead. Like, you're ahead. You know, you're 8 months ago, you would have paid a lot more in most areas. You're ahead. The real secret, based on what we've seen, Phil, is as long as you don't have a selling period that might happen within the next 2 years, right? That appears to be the issue. As long as you're prepared to be a longer holder, which you've got to be in real estate, like realistically, anyone that's buying a property thinking that they're going to sell it in 2024 shouldn't be buying a piece of real estate right now. No chance. But Phil,
so you're pointing around is the market bottoming. It doesn't matter if you can buy. I think someone left a comment. If you can buy now and you don't need to sell it, you're probably going to be okay. Better than
yeah, 100%. Phil, we'll be back next week. Really enjoyed these robust chats that we have about real estate, and I've got to tell you, I had a client say to me, a real estate agent, not a vendor or buyer, say, you know, he goes, I find that you guys cover enough information that allows a real estate agent to have the kind of conversation with a buyer and seller that doesn't sit there and sound like just a salesy commission breath person. You go, you're not economists, but you give enough information that for the average Aussie, you can get into a conversation, whether it's talking about tax, whether it's talking about inflation. I think we're the common man's commentators, Phil.
Common men, absolutely. Commentators, perhaps, you so more than me. But it's a good point, Tom. You know, when we kicked off this, it was very much, you know, we both operate within real estate. We do different things in real estate. We see different things. You know, the reason what we're doing here is that if we can sort of capture what's going on in the world and going on in Australia, and try and interpret that, what does it mean for real estate? That's pretty much our beef. And we might not always get it right. You know, we might not always be informed. Like, you know, I wasn't across these stamp duty changes. I haven't read REB over the last couple of days, so that's my fault. But don't always get it right. But what you get from us is what we think at any moment in time, right? This thing is definitely not scripted. So if we can keep doing that, mate, I like it. You know, I've enjoyed the breadth. And as we're rounding out, you know, this is getting to the end of 2022. Tom, we're going to work out 2023, what it's going to look like. But we've covered everything from elections to supply chain crises to homelessness issues to wars in Europe to potential conflict in Taiwan and national security to cybersecurity to everything, mate. And viewing it through the lens of, okay, what does that mean for Aussie real estate, Aussie buyers, Aussie sellers, Aussie agents, Aussie brokers, Australian mortgage brokers? Pretty cool.
Love to finish off with a question to you, Phil. I've been asking all my coaching clients this question. What happened this year that surprised you about yourself?
Good question. Sounds like a job interview, Tom. It's probably a really good job interview question as well, right?
I can give you more time and tell you my answer to it.
Yeah, go on. What's yours?
I surprised myself at the ability to work, even playing injured. You know, really surprised I've surprised myself. I was able. I mean, I've had to do a lot of tactics, which is very little social life. I had to change what I put in my body. There's hardly any alcohol. It's just enough to give you 8 or 9 hours of quality work a day. So I surprised myself. It's giving me a sense of confidence.
It's a really good question. What are your sort of coaching clients say? Real estate agents, what's their normal response?
One of them said, I was surprised I was able to keep ticking over after I had to let go of my PA because things got tough and I was always very worried. I had another one turned around and said, I was very surprised at my ability to cope with a changing market. I was able to convince owners to actually sell at lower figures. And another question I asked, and a lot of clients said the same thing, was what one thing did you learn this year that you're going to take with you forever? And the most common answer is that good markets don't last forever. That was the most common response to that.
That's pretty good. Yeah, I'm struggling for an answer for you on that question. If I'm sure there's some psychologists who could probably look into that somehow, but if it's not really not surprising myself, but it's more of a as I lay in even further complexity to my life, I still have. I'm surprised at my ongoing capacity to be able to compartmentalize. Probably, if that makes sense.
You're good like that, is it? You get things. You stay here. Not going to ruminate on this here because this is going to be parked here, and this issue here someone else can do, and I've got to do this. You're good at that, I know.
Yeah, but and that's just getting more and more, like, it just perpetually gets more and more complicated. But surprised at the ongoing ability to function effectively. Really, not even effectively, like very well. So yeah, I'll put some more thought to that.
Be very proud. Now listen, Phil. I've just realized you might not be able to see it. Can you see it? I've got conjunctivitis in one eye. Can you see that?
No, you're right. No.
So what I've got to do is I've actually just realized I touched the other eye, and I don't. And I've been
don't wash it off.
That's a no-no, right? So I'm going to rush off quickly and wash it off because I don't want this other guy is about to come good. I don't want the other one gone. All righty, to all our listeners, viewers, thank you so much. We'll see you next week.